We dividend investors can't resist a good deal, and in this video, we're going to cover 3 stocks that are exactly that and have seen substantially negative share price returns in the last month and so far year to date, making them potentially great buys as we head into the month of March. But before we get to those, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Also, leave me a comment below and let me know which dividend stocks you have your eye on. I'd be curious to hear what you think is looking good. Anyway, guys, moving on, the first stock that I think is looking like a good pickup in March is Kroger, which is a stock that's currently sitting on my watch list, and it's one of the leading grocery chains here in the United States with over 2,700 stores across the country, and they operate under several banners like Fred Meyer, which is popular up in Oregon, Ralph's in Southern California, and Smith's here where I live in Las Vegas. Many of Kroger's stores are paired with either a pharmacy, a gas station, or both, which helps to add recurring traffic and makes them a necessary stop in their customers' daily routines, which seems to prove effective considering Kroger holds a #1 or #2 market share in about 90% of the major markets it operates in. Having said that, the grocery industry does tend to be pretty fragmented, which is one of the risks involved with investing in a company like Kroger. However, I think buying at today's prices could come with a pretty solid margin of safety. In the last month, Kroger has traded pretty flat. It is up 0.1%, and year to date it's pretty similar, only up 1/3%. And looking at their share price performance over the last year, they are down 1.4%, which isn't anything too crazy, but they are down quite a bit from their peak share price of about $62 per share right here back in April. And looking at their valuation here, the PE ratio is nice and low, almost in the single digits, 10.63, which is nearly 50% lower than the sector median. And this is also 13.5% lower than the company's 5-year average PE ratio of 12.3, so it is trading at a bit of a discount compared to where it usually sits. And scrolling down, looking at their price to cash flow, this is also really low in the single digits, just under 5, which is 64% lower than the sector median, and it's about 10.5% lower than the 5-year average. And this price to free cash flow is probably pretty low because the free cash flow has soared these last couple of years for Kroger. Looking at how their free cash flow has grown across the last 10 years, it saw a huge jump in 2021 and 2022 compared to the years prior, so it's no surprise to see this price to free cash flow a bit lower. And looking at the dividend chart, this is being raised at a pretty aggressive rate as well. And taking a closer look at Kroger's dividend stats, we can see they have a pretty incredible 5-year growth rate, sitting just under 15%, with a pretty average dividend yield 2.3%, but look at that payout ratio, guys, just under 23%, which does indicate continued dividend growth is on the way, and they've been growing this bad boy for the last 16 straight years. And as far as what price you should be buying Kroger at, there's a couple calculations we can look at to help determine what its intrinsic value might be. One of them is a discounted cash flow calculation, and the other is a multiples valuation calculation. Now, when doing a DCF calculation, I got an intrinsic value of $78.14. For the multiples valuation calculation, I got an intrinsic value of about $63.50. And when taking the average of these two numbers and applying a 10% margin of safety, that gives us an overall intrinsic value for Kroger of $63.73, which is quite a bit above where its current share price is at. So Kroger is still looking pretty undervalued according to this. And when taking these intrinsic value numbers into consideration, guys, it's very important that you take them with a grain of salt for a couple reasons. I mean, number one, I'm still pretty novice at doing these. I'm trying to get some more practice in, and hopefully we'll get better over time. And number two, there is a lot of room for error when doing these, and everyone's going to come up with a slightly different number or possibly a substantially different number. So definitely take this with a grain of salt. Anyway, guys, moving on, the second company that I think is looking like a good buy in March is Norfolk Southern Corporation, which is a railroad company with a network that spans 22 states and covers nearly 20,000 miles of track across the country. And railroad companies in general are good investments for a few reasons. Number one, there is a high barrier to entry. It's difficult for new competitors to come into the market and take market share away from the already established, already existing railroad companies. Number two, railroads are pretty heavily regulated by the government, which should also help provide some protection from competition. And number three, railroads are essential for transportation and can transport a wide range of goods, which can help reduce the risk of revenue fluctuations due to changes in demand for any particular product. However, as I'm sure many of you know, Norfolk Southern is currently in some very hot water and is facing some pretty serious backlash after a series of extremely unfortunate derailments in Ohio and Detroit, which is sending their share price into a slump. Just in the last month, Norfolk Southern is down 11.5%, so that's quite a big drop, which brings them to a year-to-date loss just over 9%. And over the last year, they are down about 13%, so that's quite a big drop all across the board, but this is leaving their valuation looking pretty decent. On the valuation page here, we can see they have a forward PE ratio of about 16.5, which is 6.5% lower than the sector median, so not too bad, but this is nearly 15.5% lower than the company's 5-year average PE ratio of 19.61. Now, just as the negative share price performance is bringing that PE ratio down, it is pushing the company's dividend yield way up above average. Here we can see that their forward dividend yield is 2.37%, 6%, which in its own right is pretty average, but this is about 56% higher than the sector median, and this is also 26% higher than the company's 5-year average dividend yield. And taking a look at the rest of the dividend stats, these are looking pretty good as well. Their payout ratio is nice and low, 36.6%, and that 5-year growth rate is outstanding, nearly 15% with 6 years of consecutive dividend growth. And with that, 6 years of dividend growth is not really the longest, but here we can see that they've been paying their dividend for 33 straight years, so there is a lot of consistency in the dividend department. Now, taking a look at the intrinsic value for this company, the discounted cash flow calculation has it at about $218 per share, which makes it just a hair overvalued. On the other hand, the multiples valuation has it at $246 per share, which would make it 9% undervalued. And if we take the average of these two and apply a 10% margin of safety, that does leave us with an overall intrinsic value of about $209 per share. Having said that though, just based on the recent news surrounding this company, I would not be surprised if in the short term, the share price continues to see somewhat of a decline. So that's something to keep in mind if you're considering buying some more shares of this stock. And now moving on to the third and final stock that I think is looking like a good pickup in March, guys. This is Johnson & Johnson, which is one of the most iconic dividend kings who, in addition to their pharmaceuticals and medical devices, owns multiple household brands that you will have heard of, such as Neutrogena, Listerine, Band-Aid, Tylenol, Rogaine, and many, many more. Now, as I mentioned, Johnson & Johnson is a dividend king, which means that they've been growing their dividend for more than 50 consecutive years, which is a huge draw to owning this company. In fact, Johnson & Johnson's been growing their dividend for actually 6 straight decades in a row, so that's quite a bit of time, and the rest of the dividend stats are looking pretty average, I will say. 2.82% forward yield. Payout ratio is actually pretty low, about 44%, and that growth rate's really nothing to write home about, just above 6%. And because of that, because the rest of the dividend stats are kind of average, I get a lot of questions about Johnson & Johnson. Even though it's a dividend king, is it still worth investing in even though the rest of the stats are just kind of so-so? Like this comment here that says, I get that it's a dividend king, but its last 5-year growth is 20%. That's basically inflation, so what do you see in it? I'm just trying to understand your logic. And really, it's a fair question. Why would you want to buy Johnson & Johnson if there are other companies out there who offer a higher dividend yield, a higher dividend growth rate, or possibly even both? Well, there's something to be said for consistency and reliability, which are two qualities that Johnson & Johnson definitely offers, and over a long period of time, these two qualities can deliver some pretty incredible returns without a whole lot of stress. In fact, taking a look at Johnson & Johnson's total return across a very long period of time, across the last 30 years, we can see that it's outperformed the market by quite a bit. It has a total return of near 3,000% compared to the S&P, who's up 1,500%, the Dow Jones up 867%, and the NASDAQ, who's also up about 1,500%. Having said that though, in the short term, Johnson & Johnson's share price has been coming down, and the share price returns as of late have not been too great, which is good for us dividend investors. In the last month, Johnson & Johnson is down 6%, so quite a big drop in the last 30 days, and across the last, 7 weeks or so, they're down 11.3%, which is also a pretty big drop. And here, guys, zooming out across the last year, we can see that just after the turn of the year, Johnson & Johnson's share price really started to take a tumble. And this negative share price performance is leaving Johnson & Johnson with a pretty decent valuation. I mean, the PE ratio is 15.26, which is about 25% lower than the sector median. And this is also nearly 9.5% lower than the company's 5-year average. So there is a little bit of a discount there. And because it's cheaper than usual and actually lower than my average cost per share, I've been buying Johnson & Johnson in my own portfolio pretty heavily lately. And just to show you guys what that looks like, these are all of my J&J purchases for the month. We can see that I made a pretty decent purchase on February 6th, about $160 invested. February 13th, just about a week later, about $70. On the 16th, a few days later, another $90. And just very recently, I invested another $150 into J&J, totaling about $473 invested for the month, which has helped me add nearly 3 shares to my Johnson & Johnson position just this month. And as the share price keeps coming down, I'm just gonna keep on buying. Now, those were the 3 stocks that I really wanted to spend some time on today. But with that, guys, there are still quite a bit more stocks that I think are looking pretty cheap right now and are ones you should definitely keep your eye on. The first one here is 3M, which I know, guys, I know the whole litigation, there's a lot going on with this company right now, but look, they are down 10% just in the last month, another 10%, I should say. And in the last year, this company is down 25.5%. The next one is Tyson Foods, who's also seen a pretty big drop in the last 30 days, down another 7.25%. And in the last year, they are down a whopping 35%. Unbelievable. Another one that definitely has a lot going on, guys, is Intel, but they are down another 11.8% just in the last 30 days, which brings them to a loss in the last year of about 45%. Unreal. Another one to keep your eye on is KRC, which has been one of my favorite REITs lately. They're down another 4% in the last month, and then in the last year, they are down nearly 47%, so they've seen a really big drop. And then IIPR, guys, that's another one to keep your eye on. I think I actually talked about it in last month's video, but in the last 30 days, they're down nearly 7%, and then in the last year, they are down about 54%. My goodness. And then the next one to watch out for is International Flavors and Fragrances, who is down 16.25% just in the last 30 days, which brings them to a loss in the last year of about 30%. And then next up is Whirlpool, who's down 7% in the last month. Then in the last year, they are also down about 30%. And then guys, we've got Stanley Black & Decker, who's down 3.4% in the last month, and they're actually down almost 6% just today, which is pretty crazy. And then in the last year, they are down 47%. And then the second to last one to keep your eye on is Union Pacific, guys, who's down 7% in the last month, and they are down almost 22.5% in the last year. And then last but not least, guys, we've got one of my favorite companies, Procter & Gamble, who's down about 2.5% in the last month, and then in the last year, they're down 11.3%. So keep an eye on this one. And like Johnson & Johnson, I've been adding pretty heavily to my Procter & Gamble position, and in this next video right over here, I'm telling you all about that, and I'll even show you my full positions in both Johnson & Johnson and Procter & Gamble, and how they're both currently weighted in my portfolio. So click right over here to check that out, and I'll see you in the next one.